Hello students, welcome to AccountWise Academy. This is Latha Venkateshwaran. Come on students, now let us enter the topic, that is net present value. The net present value method is a key discounted cash flow technique. It is one of the most popular discounted cash flow technique that accounts for the time value of money. It takes into account the time value of money, ensuring future cash flows are evaluated in today's terms. So you are going to evaluate future cash flow in today's term, that is to the present value. Suppose future you are going to get ₹1000 as revenue or return. You are going to convert this 1000 to the present value, that is today's value. Okay, it calculates NPV by converting all cash inflows and outflows into their present value. So inflows and outflows both will be converted to the present value using a specified discount rate. What is the specified discount rate? We just saw that it is the minimum required rate of return, or in other words we can call it as cost of capital. So in the exams you will normally get the discount rate as the cost of capital only. You have to remember that. Okay. The NPV is derived by subtracting the present value of cash outflows, that is the investment or the cost. So you are going to subtract the present value of cash outflows. What is the present value of cash outflows? That is the investment cost or the project cost, from the present value of cash inflows. What is the present value of cash inflows? That is the returns or revenues you are going to get from the investment. Okay, so present value of cash inflow minus present value of cash outflow. Inflow is your return or revenues and outflow is the project cost. When you subtract, you get the net present value. When you get the NPV answer as positive figure, then it indicates profitable investment, that is returns exceeds cost. While a negative NPV suggests that project may not be financially viable, it is not good to go ahead with the project. By focusing on actual cash flows and adjusting for risk through the discount rate, NPV provides a reliable measure for comparing investment opportunities. So NPV can be considered as the most reliable measure because it considers only the actual cash flows and it takes into account the discounting factor, that is the risk factor, that is the cost of capital which you are using. So here the formula is, if NPV is greater than 0, accept the project. If NPV is lesser than 0, then reject the project. Advantages of NPV. It recognizes the time value of money. We all know what is time value of money now. It's nothing but cost of capital or discount rate or the minimum required rate of return, all are same, and is thus scientific in its approach. All the cash flows spread over the entire life of the project are used for calculations. That is, entire life of the project means if the life of the project is 5 years, what is the cash flow for the first year, second year, third year, fourth year and finally the fifth year, all will be considered. That is all the cash flows for the entire life of the project. Okay, it is consistent with the objectives of maximizing the welfare of the owners as it depicts the positive or otherwise present value of the proposals. Okay, so it is considered as an objective for maximizing the welfare of the owners. Why? Because if NPV is greater than 0 only, we are going to accept the project, or else we are going to reject the project. Okay. Disadvantages of NPV. This method is comparatively difficult to understand or use. So here we are converting all the future cash flows to the present value. For that you have to use cost of capital. All these calculations are there. So it may be comparatively difficult. Okay. When the project in consideration involve different amounts of investment, the net present value method may not give satisfactory results. For example, first year you are going to invest 1 lakh. Okay. And after fourth year you are going to again invest 2 lakhs. If there are cash outflows, multiple cash outflows which are not consistent or which has to be made in between, then net present value will not give a satisfactory result, or it cannot be considered as a method to use at all. Okay. Students, now I am going to give you a flow chart of how to calculate NPV in the exam. Okay. First, you have to list out the cash flows. Year 0, initial investment will be given, that is a negative cash outflow will be given. Years 1, 2, 3, etc. till the life of the project, expected cash inflows will be given. What is expected cash inflows? It is the return or the revenue. Okay. Next, discount rate percentage. That will be given as a cost of capital or the minimum required rate of return in the question. Next, we have to use the discount cash flow formula. That is the present value formula. Cash flow divided by 1 plus R the whole power n. R is the cost of capital or the required rate of return and n is the life of the project. Okay. Sum all present values. NPV is equal to, we have to sum all the present values, present value of cash inflows minus initial investment. One thing you have to remember, initial investment need not be calculated to the present value because it is in the year 0, it is already in the present value. Initial investment is already in the present value. Okay, remember that. Don't make mistake in the exam. Next comes a decision rule which you have to write in the exam. If NPV is greater than 0, you can give your answer as acceptable or profitable. And if NPV is lesser than 0, you can give your answer as reject the project or unprofitable. Come on students, let's solve one problem on NPV. Okay, calculate the net present value of the following project requiring an initial cash outlay of rupees 20,000 and has no scrap value after 6 years. So this is the project outflow, that is the cost of the project is 20,000 and the life of the project N is 6 years. The net profits after depreciation and taxes for each year is 6,000 per year. That is a even cash inflow you are getting for 6 years, rupees 6,000 per annum. Okay, usually when considering profit for capital budgeting, you will take net profit only after depreciation taxes. This is very important. I have even told in my previous videos. Please remember this. Okay. Assume the present value of an annuity of rupee 1 for 6 years at 8% per annum is rupees 4.623. So they have given for 6 years altogether at 8% per annum. This is the cost of capital is 4.623. Here, this is one simple exam question and a direct question. Okay. So here what they have given? They have given uniform cash inflow, that is we get rupees 6,000 per annum consistently for 6 years. And assume the present value of an annuity of rupee 1 for 6 years at 8% per annum interest is 4.623. Here rupee 1 is your future value and 4.623 is the present value. If you are going to discount 4.623 at 8% per annum, you are going to get rupee 1 in the future. So in the question what do we have? We have future value of 6,000 and the present value factor is 4.623, multiply with that. So present value of cash inflow or the cash inflow's discounted value is 6,000 into 4.623 is 27,738. Okay. So now initial cash outflow given in the question is 20,000. See here, cash outlay of rupees 20,000. So that should be taken and present value of cash inflow which we have calculated now is 27,738. On deducting 20,000 from 27,738, you get 7,738. That is the net present value. Here the net present value is positive, so you can accept the proposal. Let's solve another question where we have uneven cash inflows. A project costs rupees 25,000 generates cash inflows over 5 years, 9,000, 8,000, 7,000, 6,000 and 5,000 respectively. The required rate of return is 10%. Calculate net present value of the project. So this is your cost of capital or the discount rate. Come on students, let's solve the problem together. Okay, so the calculation of net present value is the heading. We open the following table where it has the columns of year, cash inflows. Formula is what? For finding the present value, cash flow divided by 1 plus R the whole power n and the present value. Next column. Okay, here R is 10% given and n is 5 years. That is also given in the question. Okay, so first year cash inflow is 9,000 and cash flow. What is the cash flow inflow? CF is cash inflow. Okay, 9,000 divided by 1 plus R is 1 plus 0.1, that is 1.1 to the power of 1 is 8181. Next second year inflow is 8,000, 8,000 divided by 1.1 to the power of 2 is 6608. Third year 7,000 rupees, 7,000 divided by 1.1 to the power of 3 is 5257. Fourth year 6,000 is the inflow, 6,000 divided by 1.1 to the power of 4 is 4,098. Fifth year inflow is 5,000. 5,000 divided by 1.1 to the power of 5 is 3,100. On adding all the present values, you get 27,244 as the total. Okay, now what is NPV? Present value of cash inflow minus outflow, right? What is outflow? 25,000. Inflow is 27,244 as given in the table as we have calculated, minus 25,000 is rupees 2244 is the NPV. Now NPV is positive, that is greater than 0. So we can accept the proposal and go ahead with the project. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.